for the welcoming. Let's get going with the webinar. So, as I'm sure you all know, this evening's session is all about the US market, unlocking US equity markets, your path to finding quality abroad. Now, I'm pretty excited about this one because it's my very favourite topic. I will talk happily about US equities pretty much all the time. So we've got an hour today. Please ping in your questions. And thank you to people who have submitted questions ahead of the session. We'll try and get around to as many as possible. As I said before, Sam and Lawrence are with us this evening in the moderation zone, so they'll help you out with any questions you have about any technology while the webinar's going on. Yeah, they'll let me know about any questions that you're sending in. First up, as always, a quick disclaimer. Obviously, as usual, this is not financial advice. Make sure you do your own research and seek help from a financial professional where necessary. And of course, the performance of stocks in the past is not an indication of how they'll perform in the future. So now a little bit about me. When I was a financial journalist, a full-time financial journalist, I covered the tech and the pharmaceutical sector, which is likely where my enthusiasm for US stocks came from. I absolutely love pharma and tech. It's all extremely exciting over in the US, those two sectors. The pharmaceutical sector, maybe not for the right reasons, but the tech sector, probably because there are so many amazing companies in the US. And it's a sector that we're perhaps starved of the same kind of quality here in the UK. There are a lot of amazing brands in the US, as you can see here. These are some of the ones that particularly excite me. I love the brands in the US. I love the quality. There are so many incredibly high quality companies in the US, and arguably far more than there are in the UK. It is worth noting here the need for objectivity, which is something when it comes to talking about the US that I sometimes do struggle with. It's really important, and at Stockopedia we really advocate the importance of following the data for your investment selections, rather than blindly going where your heart tells you to go. My heart often tells me to go towards Walt Disney because, as a consumer, I'm a very big fan. Today is the third working day for me in a row that I've had quite a lengthy conversation with colleagues about Walt Disney, which speaks for itself, I think. Today, we're probably not going to be talking about Walt Disney. There are a few issues with that stock, unless anyone's particularly interested. A few issues with that stock which maybe don't tick all the boxes for the highest quality at the moment. But I have fallen into the trap personally of following my love for the brand rather than what the data was saying. So in this session today, we're really going to try and focus on unearthing opportunities which are being led by data rather than what I like the look of. So why are we looking at the US as an investment? So this is the share price performance of the S&P 500 in the year to date. Charts like this probably won't come as a surprise to most of you. We've been looking at charts like this in the US for many years. This is the performance of the S&P 500 since 2010, which is a total return of almost 300%, a compound annual growth rate of 11%. And we're talking about this right now because this is the comparison with what has happened in the UK in the same time. While the US market goes from strength to strength, in the UK, I'm sure a lot of you are struggling with the sideways market, not really knowing where to turn to for your ideas, for your opportunities, feeling a little bit unsure about what's coming next, and there is solace to be found overseas. So hopefully this webinar will help you identify some of those opportunities and maybe increase your confidence in investing in the US. There are also lots of interesting things happening in the US at the moment. The S&P 500 is approaching all-time highs. It last hit an all-time high on the 3rd of January 2022, just shy of 4,800 points. We're now looking at 4,400-ish points for the S&P 500, and the market does seem to be climbing. I mean, if you look at this chart, this is since 2010. The green periods are the bull runs, where the compound annual growth rate has been well over double digits, and in each one of the bull runs it's been at least double digits, and those bear periods, those red zones, really haven't lasted very long. So if you've been invested in the US in the last decade or so, you are likely to have made some money, and at the moment there are lots of exciting things going on there. ARM, which for many UK investors has been a bit of a sore spot, listed in the US last week. Its IPO was priced right at the top end of the range at $51. It's been a rough couple of days since the IPO, but the $51 price that the company hit on its first day of trading gave it a market capitalization of $65 billion, which compares to $32 billion, which was the market cap when SoftBank bought it out of the UK in 2016. Been a lot of questions why a company like ARM, which is obviously UK based, its headquarters are in Cambridge, has chosen to list in the US rather than in its domestic market. Apparently Rishi Sunak was meeting with the chief executive, trying to persuade him to bring his company here, but well, I think the decision was the right one, for ARM to go and invest in the US. I don't think it would have received anywhere near the same valuation if it had invested here. There's more money being invested in the US at the moment, and there's more excitement there, and it's the right place for a company like ARM to list, unfortunately for us in the UK. The US financial results season is pretty much at an end. There's been a lot of things to celebrate, topped off last week by Adobe, which is another one of my favorite stocks. It saw its highest ever level of quarterly revenue, driven by the biggest buzzword at the moment, AI. So AI as a buzzword seems to be enough to counteract any recession fears over in the US. There are enough stocks in the US with a finger in the AI market, and Adobe is one of them. And because there are enough stocks which are being driven by the AI buzz, the investors don't seem to be too concerned about any economic woes, which isn't something, unfortunately, we have in the UK. We have fewer exciting tech opportunities, or indeed growth opportunities to offset any recession fears. So before we get into what the specific opportunities are, I thought I'd spend a few minutes having a look at some of the practicalities of investing in the US. I think for a lot of people, it can feel like a bit of a scary market. It's so big, and for many investors, it has been relatively off limits for most of their investing career. But access to the US markets has improved a lot over the last few years, with the improvement in platforms and brokerages. So I'm just going to run through some of the myths that have maybe stopped investors from investing in the US previously. So first up, the fear that foreign exchange can eat into your returns. Now, it's true that foreign exchange changes can make it harder to make money in overseas shares. Obviously, if the value of the US dollar decreases against the value of the pound, your investment will lose value even if the share price hasn't fallen. So it's worth monitoring the foreign exchange situation before you buy or sell shares. It adds a bit of complication into investing overseas, but when the growth on offer is like it is in the US, the fluctuations that you need to manage in FX are in my opinion, certainly worth it. Another fear that some investors have is the price of foreign exchange fees. These have come down massively. So you should choose your platform. If you're planning on investing a lot in the US, you should choose your platform based on whether or not the foreign exchange fees are reasonable and competitive compared to others. Most platforms and brokerages nowadays do allow you to trade in US shares and help deal with the foreign exchange fees for you. But yeah, just check the prices before you invest. Secondly, tax concerns. There are tax implications of investing in the US, but a few ways of mitigating these. First up, avoiding income stocks. So income stocks are charged a withholding tax of 15% in the US, even if you have completed a W-8 form. So if you are receiving dividends from US shares, you will have to pay tax on those. But if you're not a US resident, you don't have to pay capital gains tax on US shares. You have to just fill in this W-8 form, which most platforms and brokers will help you. That you just get pinged a form, sign it, and then you're away. And another myth that people often raise is the ability to trade US shares in your ISA. You can hold US shares in your ISA, but you can only put GB pounds into your ISA. So you will need to pick a platform which allows you to invest in US stocks, but in British currency, which is most of the commonly used ones like IG, AJ Bell, Hargreaves Lansdown. So you can hold US stocks in your ISA. So we actually had a question that came in before the webinar on this, which I thought I'd address here. So typically US equities don't offer significant dividends, preferring share buybacks. How does this influence how you analyze them? So thank you for this question. I personally am not an income investor in the traditional sense of income, i.e. receiving dividends. I like it when companies reinvest their profits into the business. And similarly, I actually prefer buybacks to dividends. And I think it's a better use of free cash. I think investors tend to see greater returns if a company is investing in the business. And sometimes I do feel like in the UK, some companies pay out a little bit too much in dividends. So if you are looking for income from your US portfolio, it's better to take the income from your capital gains, because if you're not a US resident, you don't need to pay capital gains tax on US shares in your ISA, as long as you completed your W-8 form. But you do get charged that 15% withholding tax on dividends. So the amount of dividends paid by US companies isn't actually something that worries me, because if I want to take income from my US portfolio, I'm not actually relying on the dividends that companies choose to pay out. Next up, platforms and brokerages. Some people are worried that platforms don't allow US share dealing or that it's too expensive. Now, there are actually many excellent platforms for buying US equities. You should definitely have a look, if you are looking to invest in the US, for a platform that allows you to invest in the type of companies you're after at a reasonable rate. So to invest in US shares, you have two different opportunities. The first one is to pick a platform which offers cheap FX fees and dealing fees. You can see some of these in this table. If it's quite small and you think there's quite a lot going on, this article is actually already available on the Stockopedia website, and we can send you directly towards it after the webinar. But just in summary, Interactive Brokers is a very competitive platform when it comes to FX charges, just 0.02%. A minimum of $2 on per trade on FX fees. And IG, which is actually the platform that I use, is the cheapest when it comes to custody charges and trading charges. Trading US shares via IG is free if you trade more than 3 shares a month. So that's quite nice. Alternatively, you can pick a platform which allows you to hold US dollars. And in this case, you convert your investment, your sterling investment, into US dollars. And then you simply trade the shares in their domestic currency, which is a lot cheaper. But obviously, if your investment is in US dollars, it can't be held in an ISA. So be aware of your capital gains tax. Charles Schwab is a good example of this sort of platform. And there are lots of others out there. And finally, Analyzing US stocks is hard because of different accounting standards, market dynamics, valuations. Obviously, the valuation argument is a pretty big one in the US. So US stocks do have a different reporting cadence. They're obligated to report their full earnings once a quarter rather than every half year. It does mean that the US reporting season barely ends. But once you get the hang of the stocks in your portfolio and their reporting cadence, it's far easier to understand which earnings reports are more important than others. Like, for example, it's just like in the UK, retail companies rely on their Christmas trading period. Apple, it has a slightly off-center reporting period compared to the rest of the big US tech companies, so its financial year end is slightly different. All these little nuances are worth getting your head around, but they're not actually as difficult as maybe it would seem. And the metrics you use to assess for quality in the US, return on capital employed, operating profits, they apply. They're the same as the ones you would use in the UK. And it's worth taking a little look at some of these right now because that will help us address the valuation point. So these metrics in the table are the average metrics for the top 10% of companies by market cap. Obviously, there are a lot more. It's about 500 in the US. It's about 100 in the UK. Not a huge amount of difference, which actually surprised me in the operating margin between these two sets of stocks. And the same with return on capital employed, both double digits, both relatively decent averages. Where there does become a difference is in this growth. So on average, the top 10% of companies in the US have an average 5-year sales growth of 12% and an average 5-year earnings growth of 13%, compared to 5.6 and 6.3% in the UK. And then, of course, valuation. The average price to earnings ratio of US stocks is far higher than it is in the UK. Now, this can be off-putting, especially if you're used to UK valuations, but it is worth looking at the US stocks on a case-by-case basis and looking at those growth metrics in particular. The PE ratio, the point of the ratio is it shows how much of the future earnings are baked into the current valuation, and faster growing earnings they go some way to justifying a far higher price to earnings ratio. So if you're seeing price to earnings ratios 20 plus, I mean, in some cases 40 plus, yes, that can be off-putting, but have a look at the sales and especially the earnings growth of those companies. Because if the earnings are growing at 20% every year, that actually suggests that price to earnings ratio could well be justified. A couple of other practicality points before we move on. The RNS in the UK in the morning is invaluable. Is there a US equivalent? And if so, how can we in the UK access this? Yes and no, there is an equivalent in the US. It's the SEC's online filing system for company reporting. It's known as EDGAR. It stands for Electronic Data Gathering, Analysis and Retrieval. There are so many forms to fill in the US that US shares have to fill in. Wouldn't necessarily recommend it because it does look slightly overwhelming. I use mainstream news outlets like the FT and Bloomberg, and then to see which companies have made announcements. Big US companies generally do get coverage, and then I go onto the company's own website to actually look at the announcement. And another question about sort of practicalities of US investing: what should an average PE ratio be considered reasonable when considering US stocks? That's a tricky question, and it certainly should be considered on a case-by-case basis. But there is, as I said, more room for leniency in fast-growing companies which have high operating leverage, which can therefore squeeze more profits from rising sales, and you do tend to see that in some of those US companies. So now let's move on to actually identifying some high quality US stocks. Now, the task of identifying high quality US stocks is quite a big one, considering how big the market is, especially compared to the UK. And it is tempting in the US, as I said at the beginning, to chase after big brands, that household names among both consumers and investors. And it's also quite tempting to scour message boards and Twitter to have a look around among people who you feel may be more knowledgeable than you are, to whittle down your investment universe. But instead, at Stockopedia, we recommend using screens to help make that investment universe seem a little bit more, a little bit smaller, a little bit more manageable. So we've got a couple of screens within the platform ourselves, and you can also set up your own screens. So one of the recommended guru screens, which has performed particularly well in the US, is the Bill O'Neill Can Slim screen. So Bill O'Neill was a US investor who was one of the first investors to use data analytics at the heart of his investment process. And so his process, which is known as Can Slim, which is an acronym for the 7 traits which he deemed the most important for a stock to grow in value. So these 7 traits, which they are online as well, so I'm going to just run through them quickly. But yeah, you can see them online if you want to replicate this screen. They are the current quarterly earnings per share, which is up strongly, so more than 20% on the same quarter in the prior year. Annual EPS increases of more than 20% over the last 3 to 5 years. New products, new management, or an event which can act as a catalyst. So at that point, slightly harder to screen for, but once you've got your shortlist, you can have a look for that sort of announcement. Scarce supply, but strong appetite for the shares. Companies which are leaders in their market, institutional interest in the shares, and market direction pointing upwards, so share price growth. Because some of these metrics are numeric, they're quite easy to screen for. And our Bill O'Neill screen, which you can see the performance of in this chart, has performed very well. It's outperformed the S&P 500 since 2013. And there are some interesting opportunities in that screen right now. So go and have a look. Next screen, which I like for identifying US opportunities, is one based on the Buffettology method. So obviously Warren Buffett, very famous US investor, made most of his money in US shares. And unsurprisingly, the Buffettology screen has performed extremely well in the US. So this screen, it also looks for growth, so an earning growth streak of at least 4 years of earnings growth. But then it also has a few more quality metrics as well. So a return on equity of 15% on average over 5 years, a return on capital employed on average over 5 years of 12%, and also decent free cash flow metrics. Cash is something that's very important to Warren Buffett. There's also some valuation metrics in there. Buffett obviously a little bit more wary about value than some of his US investing counterparts. So these two ready-made screens, which I recommend. But also at Stockopedia, you can, of course, set up your own screen, which I am going to show you how to do quickly now. I'm just, so this is my screen sharing live. So setting up a new screen like this. As you can see, I have got my profile on US only, so these are all US stocks. I'm going to give my screen a name just to start off with. So, and then I will start adding rules. So first up, I am looking for a market capitalization over a certain amount. So there are big stocks in the US. So I'm happy with, oops, too many zeros. I'm happy with over $1 billion. Or £1 billion. I also am going to use the quality rank, because why wouldn't I? I'm looking for stocks with a quality rank of more than 80. So the Stockopedia ranking data, for anyone who doesn't know about it, we don't quite have enough time today to go into to how we build these ranks, but the quality rank helps to take out a lot of the legwork for identifying high quality companies. They rank from 1 to 100, 100 being the highest quality stocks based on our algorithms. So looking for shares in the top in the top quartile of the ranking data is helps to identify, helps to make the investment universe slightly smaller. I'm going to add a few more rules as well. So you can either browse through all the various different metrics that we have in our screening system, or you can search for metrics you're interested in. So my favorite metric is the return on capital employed. And I am going to look for a return on capital employed over 5 years of higher than 20%. It's quite high. I'm looking to whittle down this investment universe quite quickly. One way of making sure you don't exclude too many stocks early on in your screen is to make those rules a little bit less rigid, a little bit less hard to hit the metric. So maybe go for something slightly lower than this if you want to have more options in your screen, which you can then do further research into. But for now, I'm going to have quite high rules. You also, at this stage, you might want to add more recent rules. So that in that return on capital employed, I've looked at the 5-year average. Obviously, a 5-year average could mean that 5 years ago the return on capital employed was 60, unlikely, but and it has been going down and down since then. So some investors might want to add a return on capital employed over trailing 12 months to make sure that return on capital employed has been maintained recently. Another important quality metric is the operating profit margin. Again, I'm looking for a 5-year average, although you might want to add a trailing 12 months as well. And again, I'm looking for at least 20%. Cash flow is very important. So I am going to look for the cash flow return on invested capital. And for this one, I'm looking for a ratio of about 15%, of more than 15%. And finally, on the quality thing, I'm looking for gearing. So the net debt to equity gearing figure helps to ensure that these companies' balance sheets are in good health. So for this, I'd like a ratio of less than 50%. And that's my screen. I'm going to sort it by market cap and save it. And as you can see, unsurprisingly, at the top of the screen, some of the biggest companies are those software companies, those extremely high margin companies. So some interesting opportunities there. Obviously, I haven't got any valuation metrics in my screen at all. So it is worth taking a look at those as well. But for the sake of this webinar, this is a quality webinar. This is the outcome of our screen. The webinar, of course, will be available to rewatch if you want to see all that again. But for now, we'll go back to the presentation. So finally, at Stockopedia, as I said, we have our algorithms which aim to make it easier for you to pick stocks which are more likely to make you money. As I said, the details of how and why these stock ranks work is not something that we really have time to go into. But there have been a couple of questions about the stock ranks and the NAPS portfolio building process, which is Ed's way of easily building a portfolio which relies on these on the stock ranks. It's a factor-driven portfolio and it performs extremely well. So the questions we've had are, it would be great to hear some stats from the NAPS approach when applied to the US market. and I have not found high QVM shares do as well in the US. Am I unlucky, or is there another reason? So firstly, on the first point, the performance of the naps in the US, it's actually performed extremely well since 2013 when Ed started using it. So the blue line shows the performance of the US naps and compared to the New York Stock Exchange and the Nasdaq. So it has outperformed. But then on to the second point about the performance of the QVM ranks in the US. Now, it's true that the QVM as a whole has actually underperformed in the US, and that's because the QVM, the stock rank is equally weighted between quality, value, and momentum. The US has not been a value market for a very long time. Between 2010 and 2020, value was deeply out of favor. So there was a drag on the QVM. But since 2020, when value has been back in vogue, the stock ranks, so the QVM highly ranked shares, have actually outperformed. So it is worth taking a look at what's happening in the market when you're applying those the factor approach in different geographies. But we are still confident in the performance of the stock ranks, especially at the moment in the US. So finally, before we move on to the Q&A, we're going to take a deeper dive into two stocks which are particularly interesting at the moment. I feel it would be almost remiss to talk about the US market at the moment without mentioning Indivior. Indivior, as I'm sure many of you know, is a semiconductor company which makes chips. And fortunately for Indivior, it makes chips mostly for data centers. Over 3/4 of its revenue actually now come from the manufacture of chips, semiconductors for data centers. So data center revenue is rising so much at Indivior because of external demand. External demand which is driven by AI. So for artificial intelligence, AI, like ChatGPT to work, it relies on huge stores of information and these massive data centers. And the graphic processing units which facilitate these data centers are made largely by Indivior. It's far and away the biggest company making chips in this space, and it has very high barriers to entry because firstly of its proprietary software and hardware, which allows it to make these unique chips, but also for the relationships that it has with the data center providers and the companies that are using the data centers. AI is nowhere near its peak yet. It has only really arrived in consumers' consciousness relatively recently with the launch of sites like ChatGPT. The AI market is forecast to grow at a compound annual growth rate of 34% a year over the next 10 years. So companies like Indivior are extremely well placed to benefit from this surge, which explains why the share price has surged as it has done in the last year. Indivior doesn't really have any meaningful competitors in the graphics processing unit provider space. So it is in a very good position to keep benefiting from this surge in demand. We can see in the stats in this table here, revenue has risen at compound annual growth rate of 22.7%. That's over the last 5 years, and that's only accelerating. Indivior's revenue growth has been extraordinary this year alone. It's now its operating margins are also expanding quite quickly. Operating margins in the last 12 months are 33%, which compares to just under 30% over the 5-year average. And margins are expected to keep expanding because, like many companies in the software space, Indivior has a very high degree of operating leverage, which means that costs don't increase at the same pace as the rising revenues. So rising revenues gives way to faster growing profits and higher operating margins. But we should mention valuation. After a 200% increase in the share price in the year to date, shares are now trading at 40 times forward earnings, which means that Nvidia has a value rank based on Stockopedia's stock ranks of 1, which is as low as it gets. So is the time to buy now? I think that's a tricky one. My hunch is that the boat has been missed for now, and there might be a dip at some point. That with a valuation like that, Nvidia can't afford to miss any expectations, and it hasn't been missing expectations. But as soon as it does, the shares are likely to take a tumble. But it is a brilliant, high quality company in a very fast growing market where it has extremely high barriers to entry and huge opportunities for further expansion. So a brave investor might want to jump on the Nvidia bandwagon, but has the ship sailed? I rather think it might have done. But looking at a stock that the ship definitely hasn't sailed is Garmin. I was sort of trying to look beyond the tech industry here, and I mean, there are lots of fabulous companies beyond the tech industry in the US. McDonald's, Starbucks, these are both really incredible companies with wonderful brands. In the case of McDonald's, an amazing franchise model, which is extremely profitable for a company in the hospitality space. But I landed on Garmin because I feel like it deserves a little bit more credit. So it has, as you can see from the share price chart, been relatively underloved, which seems a little bit unfair given its credentials. So in 2008, Garmin made $2.5 billion of its total $3.5 billion in revenue from automotive navigation. 2008 was actually the year that Google launched its maps, and it obliterated demand for satellite navigation products like Garmin and TomTom. But Garmin has never been an exclusively sat-nav operator, or now an exclusively wearable devices operator. It's a satellite navigation company which goes to the end markets, which are the most attractive at the moment. And because of the diversity of Garmin's end markets, its revenues have climbed even in periods when its largest division, like the sat-nav division, the automotive navigation division, was completely obliterated by the launch of Google Maps. Now it's looking at almost $5 billion worth of revenue. The growth statistics obviously aren't quite as attractive as we just saw before with Nvidia, but just under 10% of a compound annual growth in revenue is nothing to be scorned. An operating margin of 20%, averaging 23.5% over the last 5 years, is also pretty decent. EPS growth has been a little bit disappointing as the company keeps investing, but again, 6.1% EPS growth on average over the last 5 years is not bad. And there are potential exciting areas of growth in its end markets as well. Garmin right now is benefiting from the surge in demand for wearable devices, fitness products, but it still has an arm in that in the autonomous navigation market. If autonomous vehicles do start to become a thing of reality rather than a thing of science fiction, Garmin is very well placed to benefit. It actually already has a product which is in autonomous planes, planes that can land themselves in the event of a pilot emergency. It's far less flashy than its big tech counterparts, but I quite like that about Garmin. It is doing amazing things in technology across lots of different markets. So the marine markets, aviation, cars, and obviously the consumer market. And it is worth taking a look at. So we've got 15 to 20 minutes left of Q&A. I'm gonna quickly address some of the questions that came in before. I hope you found the presentation useful as well. It will be available, all the slides will be available, and the recording will be available afterwards. But yeah, moving on to the Q&A. I had a question that came in about Taiwan semiconductor manufacturing, which I thought was worth addressing while Indivior is still in people's minds. So the investor who asked the question has recently invested in TSM, and the share price has been pretty disappointing compared to Indivior, or just even on its own, it's been quite disappointing. So Indivior does actually not really have the same exposure to AI as Indivior does. Sorry, TSM doesn't have the same exposure to AI as Indivior does, and that's really what's been driving all the excitement in the share price for Indivior. The semiconductors that TSM makes are used in gaming consoles, smartphones, computers, and much smaller part of the AI market. The other way that it differs from Indivior is it's a manufacturer. So it makes chips for customers for whom it has contracts, which actually includes Indivior. So I'd say it's not actually a competitor, it's more of a partner of Indivior. And because it's a manufacturer, it means that the barriers to entry are lower. Because while companies like Indivior are busy innovating and creating their own novel chips, which are then used in data centers, TSM is simply a manufacturer. The barriers to entry still exist. To be a semiconductor manufacturer is not something that anyone can just do, but the barriers to entry are definitely slightly lower. But still, the margins are really, really high, and it's a high quality company. It's a better valuation. Frustrating timing to buy, but buy and hold companies are for long term. So try not to let short term fluctuations put you off. So another question which came in, which I thought was quite an interesting one, was that many US stocks are priced very high, so it's difficult to purchase an adequate amount of units to make it worthwhile to buy quality companies. It's a very fair point. US share prices tend to be in the hundreds of dollars or thousands of dollars, or tens of thousands of dollars, which can be off-putting. But fractional share dealing is offered on most platforms and brokerages. And as long as you invest in liquid companies, which are not in short supply in the US, should be okay. But yeah, definitely worth being wary of those extremely high share prices, which means you can only really buy like 3 or 4 shares in some cases, or in some cases, like if you're trying to buy a Berkshire Hathaway, you're only going to get a fraction of that share. Okay, so moving on to the Q&A that I've been sent since we've been talking. Loads of questions. Right, one that grabs my interest there. Claudine, looking at quality stocks in the healthcare space. Have I looked at any? Yes, definitely. So there are a few really interesting healthcare companies outside of the main sort of pharmaceutical arena. There are some really high quality pharmaceutical companies like Merck, but I'm aware that there are sometimes issues with investing in pharma, in big pharma in particular, including ethical issues. So beyond big pharma, there are some interesting opportunities. IDEX is a company that I really like. It actually operates in the veterinary market, and very high quality. Lots of good stats for IDEX, and also an end market which is growing very, very quickly. And West Laboratories, which produces the packaging and the kind of things that pharmaceuticals get contained in, is another really interesting stock in the quality US healthcare space. So it still has exposure to that quite exciting US healthcare market, without the fluctuations that come from investing huge amounts in R&D like the traditional big pharma companies do. So that's a couple that I quite like in that space. Do you use any strategies when investing in US stocks to hedge against currency movements? I actually personally don't, because I, as a buy and hold buy and hold for as long as possible investor. I am less concerned about huge currency fluctuations. I'm really interested in the quality of the stocks. Perhaps I should look a little bit more, but it's not something that keeps me up at night too much, because I'm hoping that my stocks over the long term will deliver for me. But hedging against US currency movements is definitely something that is useful if you have the time to do it. Quite a few questions about currency, actually. Clearly something that is on people's minds. When selling US stocks, should you pay out in GB pounds or in dollars? So it depends on which of the platforms you use. So if you're using a platform where you have converted your investment into US dollars before you buy and sell, then you're selling in dollars. But if you have a platform like IG, your portfolio is all still in pounds. So the currency, the foreign exchange changes will be reflected when you sell the shares. A billionaire has a bet of $1.6 billion on a US market crash. What does he know / think? What does he know / think? Unless he has a crystal ball, he doesn't know anything. But what he maybe thinks is potentially political. It's obviously an election coming up in the US, which may have some impact on the markets, depending on who the next president is. There are also still economic issues in the US, which, I mean, it's the same kind of situation which is impacting sentiment in the UK. But in the US, I think the companies are doing the talking a little bit more than the markets are. Obviously, yeah, there could be a crash, but as the share price chart, the S&P 500 chart that I showed earlier, indicates the sell-offs in the US recently, at least, haven't lasted that long. There are a lot of legitimate concerns about the end of this run. I have spoken to Carson Block, who is a short seller in the US, quite a few times over the last sort of 5-6 years. He's very, very negative. He's a short seller. He makes money when markets do badly. And the US market is what he calls a powder keg economy. He says that the markets grow and they grow and they grow, and then something bad happens. He points to things like the 2008 financial crisis. He points to COVID. And when something bad happens, the powers that be will step in and provide recovery in some way. They'll provide more cash. They will stuff more powder into the keg in order to keep that market ticking upwards. And he is concerned that there is only so much powder that you can shove into the keg until it explodes in a really big way. I spoke to him shortly after the COVID crash, and he said, it's here, it's happened. The keg has exploded. And he was wrong. And I spoke to him again more recently, and he admitted that he was wrong. But he continues to be quite negative about that, the outlook for the US. He thinks that at some stage everything will come crashing down, and it's a fair thing to fear. But in the meantime, I think there's still money to be made. Okay. Question about the US political circus. I honestly don't know the impact of the US political circus that goes on and has in the stock markets over there. I would say it has an impact, but the extent to which it has an impact, I think, is probably outweighed by the companies themselves. So while whatever politician can be saying whatever strange or annoying thing, or sometimes sensible things, the companies are probably doing the talking better, which is how the markets should be, I suppose. Questions about recovering the dividend cut the US tax authorities take from foreign holders on US stocks. As far as I know, that 15% is not recoverable. You have to pay 15%. But if you filled in a W8 Ben form, you shouldn't have to pay twice. So if you haven't filled in the W8 Ben form, you'll be paying tax as a US citizen and as a UK citizen, which is obviously paying tax twice, and nobody wants to do that. But as long as you filled that form in, and that is very, very simple, it should be quite plain sailing to only pay the amount of tax that you actually have to pay on US shares. Apologies if I've been saying Nvidia wrong. I think I have. Nvidia. You're definitely right. Glenn, right. Thank you. I have a question. I have a question from Lawrence, which is whether or not I will ever sell my Disney shares. I think Lawrence is asking this because this is a question that has come up several times at work over the last few days. And it's an interesting question, and it's a difficult question because selling shares is not something that I'm very good at. It's something that we did a webinar with Robbie Burns recently, which I would really recommend rewatching if you haven't seen it already, where he talks a lot about selling and having the discipline to sell shares. And I think that is something that is quite tricky when you invest in stocks that you feel passionately about. And I feel passionately about Walt Disney, so I feel passionately that it will recover. But I know that that's a psychological, it's a behavioral psychological trait, which I am not proud of. So not investing in stocks for reasons of personal enjoyment can help overcome the feeling of not wanting to sell them, even when everything's going horribly wrong, which it is for me with my Disney investment right now. A question about the valuations of the US market. It seems overvalued. It does well compared to the US market, which is undervalued, and does badly. It does not make sense. I agree, it doesn't really make an awful lot of sense, but there are reasons that help to make it make a bit more sense. So the UK has been doing very badly recently. There have been huge fund outflows from big pension funds, as pension fund managers have sought security of fixed income investments. And the amount of money in the equity markets in the UK that was being propped up by these pension funds is really problematic. And it's something that the government is really keen to take a handle on. Regulations like MiFID II, which made access to analyst notes and research far harder, has really not helped the situation in the UK. And there needs to be more done to encourage private investors and encourage companies to list in the UK. The case of Arm is just a prime example of the fact that we need to be doing more. In the US, I feel like the attitude is far, far removed from what it is in the UK. So the attitude for investing, whether or not you are a company chief executive and you're investing, or whether you are a private investor and you're investing in that company, investing in growth at all costs is a far more common mentality in the States, and we can see how that's played out in the markets. Nvidia, has had a really, really exorbitant valuation for a very long time. Amazon has had a crazy valuation for a very long time. Apple was worth $1 trillion 3-4 years ago. It's now worth $3 trillion. These are valuations that we just won't see in the UK, but it just keeps on growing and growing and growing. one of the reasons is because of the actual growth of the companies. These companies are taking those profits, those really high profits they're making, and they're reinvesting them into further growth, because the attitude there is for growth. It's a reason why I much prefer the attitude to reinvesting back into the business, and even in share buybacks, to investing to returning money to investors via dividends. More often than not, when I receive a dividend, I reinvest it back into the company anyway. I would rather that was being done higher up the chain, and it was being invested back into the profitability and the growth of the business. So while I agree with you that the UK market should be doing better with the valuation compared to it is in the US, I feel like attitudes here need to change before we see any kind of the level of growth that they enjoy in the US. Do I get any benefits of owning a Disney share? No. At the moment, there are zero benefits of owning a Disney share, but I don't get a discount on my Disney Plus subscription, so that's a shame. I don't get free park tickets either, which would also be a nice perk, but I also don't really want freebies as an investor. I'd rather the company started making a little bit more money. There are still quite a few questions, but I am conscious we have reached the end of our hour. I will try my best to try and address as many of these as possible in some articles that will be sort of being published. Some of the questions that have been asked are things that we're planning on writing about over the next couple of days anyway. So keep your eyes peeled for them.